And I want to mention also that for this interview, let me go to the webpage right now on feettothefireradio.com. If you go to the page and scroll down, you will see the information for this segment. Lionel Parkinson, the coming of negative interest rates and how to save your savings. This will be on the archive page if you're watching this video in its reproductive form as opposed to live. And this will still be in the archives for the date associated with this, which is July 3rd, 2016. You'll notice there's a link to a PDF. Now, if you're listening live now, or even if you're watching on the live stream isn't terribly high resolution. We will be putting documents on the screen, but you might want to download this anyway. Plus, this will change as more information comes after the show. I will add it to this PDF. And so this is something you might want to check on from time to time to see what Lionel's been talking about as going. So I wanted to bring this up now for those who are listening live, especially if you're listening to the audio as opposed to watching it. You can click down and download this PDF. It has been updated with some information Lionel sent me earlier today, and you can kind of follow along with the information. Lionel has been on the show, for Holy Virus, which is really a phenomenal work in and of itself. And Lionel can now rest and go to the proverbial St. Peter with this book. It is and present it as a life's work. It is very wonderful and dynamic. Links to Holy Virus, holyvirus.com can bring you videos and the books. And Lionel graciously has given Feet to Fire exclusive deal for any of our listeners, so that if you go to Feet to Fire webpage, in fact, I'll scroll down here. I'll take this second to scroll down. You'll scroll down, you'll see that there is going to be a banner, Holy Virus. Underneath there, you have text that gives you a username and password that you can click on a link, log in there, and get a special, incredibly special price. And many times, Lionel actually loses money in it, but it is a very good price on a hardback book of the Holy Virus. Now, what's he here for today? Well, in the past, and I have a YouTube video up here linked, Lionel has warned us about the inflating nature of gold prices. And at the time, we did get some comments about this was, ridiculous. Gold has always been a source of value, and it's always been this and that. But learning from Lionel that gold was really it's an emotional value. The real value of gold is really electronics, coding, for circuitry and all that. Everything else is emotional. Gold for jewelry, gold for investment. It's all emotionally been doing. It's been going on for years. But Lionel warned about the prices were really high. They were artificially high, and that they would come down and crash. And at the time, the prices were about $1,900, I think it was, and it went down to now it's $12. So since this video went down 500 points, and there's more to come. And at the time, they were toting about it being from $2,000 to $3,000, $4,000, $5,000, and it never reached there. So that is something he did before. And this is his personal, he's coming online here and sharing publicly his own personal choices. He invested in gold and sold at the proper time and made a lot of money on it. Now he's figured out what's coming, which is negative interest rates, and we'll explain all about that, and what you can do to protect your money in this. And I will say at this point that Lionel is not selling you a fund or a newsletter. Lionel is just doing this basically out of his own heart to help people who he sees being caught up in the negative interest rates, which is a clever way of saying basically confiscating your money to help oil the Ponzi scheme, which is running out of numbers as they create the debt. They're starting to run out of numbers, which people believed was infinite. But okay, I've been long-winded on that, but let's bring in Lionel at this point, and welcome to the show, Lionel.
Hey, thanks again, James. Your start on explaining things is excellent. I really appreciate that. The beginning part, because you hit on the head some of the important parts of the past, and I really appreciate that.
Well, so tell us, we did see in Europe, we saw the bank holidays in which people found that their credit cards, or at least their bank cards, were turned off, and they couldn't get their money. And some of them found that a percentage of their savings was borrowed with no definite payback to help pay out the debt that they were in. Cyprus being one, and we all know about Greece too. And from America, of course, being invincible in America, this will never happen here. It's only over there, those people over there type thing. But you have noticed that there is a way for this to happen here, which is coming, and through the term negative interest rates. Now, when you want me to bring up one of your documents, because I already mentioned about downloading, if you want me to bring up a section, just kind of give me a clue, and I'll bring it on screen for those watching the video.
Okay. Yeah, I do remember in our private discussions over the phone that I would send you certain information through emails that you could use, and I should have some of those handy, but I think it would be best as I talk about this matter that you just find the segments that I sent you and put them up.
Right,
I'll
do that. I'll do that.
Yeah, negative interest rates. If you don't mind, I'll just begin and shoot right into it. This, I think, is one of the most important time frames of this ongoing banking crisis, which has been going on since the 2007-2008 banking crisis. The big taxpayer bailout that occurred right during the time that everybody was in the process of voting for the next president, and as you can see, the results wouldn't have mattered who would have became a president. They would end up doing whatever they're told by the bankers, which is bail them out. And it was known as the taxpayer bailout, and it went on. And the markets bottomed pretty much on March 9th, 2009, and everything started resetting again. The banks got an additional infusion of money from the Fed, and it really didn't work. They still needed more and more money. And when I was researching this, as time went by, we did a program, as you mentioned earlier in the intro, about gold and silver, and it was October of 2012, and I had warned that gold and silver were not going to inflate to outlandish prices, that they were actually going to come down, and you did accurately mention what the price of gold was. It was right around 1900, and silver was around 37, and it took years after that gold hit a bottom of 1100, and silver hit like around 13. So even though it was a severe crash, it wasn't quite as deep as I had thought, because another event came into place prior to that prediction, and that was the Dodd-Frank Banking Reform Act. The Fed could not infuse enough money to the banks after the taxpayer bailout and after the Feds gave what they could to the banks all over the world. It still wasn't enough. They were going to fail, and even on that program, I was warning that we could see another major collapse, a global financial meltdown. So they had already prepared for this during the 2010 Dodd-Frank Banking Reform Act, which is actually a bail-in. And that bail-in, it infuses or it incorporates all the bank accounts of people's savings accounts and their checking accounts to be legally and technically turned over to the ownership of the banks. The Dodd-Frank Banking Reform Act pushes away taxpayer bailouts completely, but infuses the banks with the protections of any derivative bets that the banks made, and makes them the senior priority bailout of any financial crisis. So essentially, to break it all down, they gave the banks the legal right to own your checking account, your savings account, any kind of money that you deposited, it automatically goes to the ownership of the bank for the purposes of bailout. So since 2010 to the time of now, they have taken that $8 to $10 trillion worth of savings and doubled down on all the bets and derivatives, and now it's forced upon us a situation where the banks have to get more money. They have probably lost everybody's savings and their checking accounts, and it's forcing a global phenomenon that has never been seen in the history of banking, and that is lowering of interest rates to zero, and finally to what we are going to talk about on this program is negative interest rates. This going negative means that whenever people park money in a bank, they will be charged whatever percentage point of negative interest rates for just simply putting their money in the bank. Let's say that they want to start charging 1% to begin with, to test the waters, to see how people react. Now, of course, a lot of people are now seeing that negative interest rates are going to be or becoming a reality, because even as we speak, there's about $11.6 trillion around the world that is now yielding negative interest rates. That means $11 trillion the banks outside of the United States are now being charged an interest rate just to park their money there. Mainly in Japan, it's a little over $5 trillion, and you have France with about $860 billion, Netherlands, Belgium, Austria, the list goes on. This phenomenon will just get worse, because this is telling me that the bail-in already occurred and started in 2010, and it is not going to begin in the next financial crisis. They have already bet with people's savings and their checking accounts ever since 2010. So first came the taxpayer bailouts. That wasn't enough. Then the feds came in and infused them with trillions of dollars. And then in 2010, the Dodd-Frank Banking Reform Act gave the banks the right to own and gamble with $8 to $10 trillion of savings and checking accounts of the people in this country. So they have pretty much lost everybody's money up to this point, and the only way that they can get more money is to now start charging negative interest rates on people as they work hard and save their money and put their money in the bank. It will come to this country, and I know it's a guaranteed locked-in event, because they don't know how to fix this global, what I call a deflationary credit meltdown.
Now, we were talking a little bit, and I was kind of musing, how could they sell this to people? Because they're going to just charge you to keep your money in the bank. The knee-jerk reaction would be for people to take the money out of the bank and put it in another bank that doesn't do that, which has happened with checking accounts, totally free checking, et cetera. And then I was musing with you, and I said, all they have to do is point to the unrest in the world, the financial unrest in the world, and sell this as it's going to cost us to keep your money secure, and this is where it's come from. That might be like these, the marketing point of it. You look pointing to other banks going down, but this will keep, so you're paying a little bit to keep a lot, as opposed to the more honest way with just taking a percentage of it. And it also creates an income stream that will continue, and of course has to get higher and higher and higher, and so on.
Exactly. How are they going to sell this, and how are they going to get it totally accepted to the people? And this is the way I believe it's going to go down. Because they have lost the savings and everything that has been built up for decades by the people in this country and around the world, by the way. Because as you well know, and I'm sure you've had other people on your program explain this, that these banks have notional value derivative bets that have gone way beyond the actual money that has been saved up by the people in the countries at a tune of maybe 21 times what has been worked for in the global economy. For instance, there may be only, like in this country, about $10 trillion in savings, but the 5 major banks have gambled beyond $280 trillion. So any major loss can suck up the underlying principal, such as $10 trillion, and all of a sudden they're dead broke. The only way they can keep this game going is to use another method, and I believe that method is going to be negative interest rates. So in order to sell this, they're going to wait until the next financial collapse, when I believe the credit cards, the debit cards, everything kind of shuts down temporarily until people realize, hey, we can't function anymore. It's almost like as if the grid shut down, even though it doesn't. It just the money literally comes to an end. It fails. So the only way that they can kickstart it temporarily and keep the game going is to get another infusion of money, and that other infusion of money is the leftover money that's in the $14 trillion economy that we have. So as the money gets pours out of the stock market and back into banks, they are going to hit it with negative interest rates and start almost like taxing it. However, I think that they're going to really hit it hard, and they're going to sell it under the pretense of income equality by making it sound like the rich people are getting hammered, when in fact it's really the middle class, because it's the middle class that has savings accounts.
Everybody else got property or stocks. Let me just stop here for a minute. I was poking around here while you were talking, and there's two things that one of these things you may bring up. We're going to bring up, but but we're talking about derivatives, and I was looking at how many derivatives are actually outstanding? How much money is in the derivative market? And I looked at here a quote from November 13th, 2012, saying that there were $639 trillion is estimated it being at that time. And I said, well, that's a few years ago. And so I'm scrolling around, and I got it on screen now. How much money is in the derivative market? One of the biggest risks to the world financial health is the $1.2 quadrillion in derivative market. 1.2 quadrillion. I mean, a trillion is a ridiculous number. And when you talk about 600 trillion, it's beyond comprehension. Now we're talking in quadrillions. I mean, those numbers, like, when you're going to start counting sands on the beach around the world to start coming up with those kind of numbers. And this is where this has to be paid for, as these derivatives are mixed in, mostly bad now, I guess, with good stuff. And there's a point here I wanted to bring up from your paperwork, and if maybe you were going to get into this, but if these banks are out of money, it's like illegal to have a bank running in the negative. They shut down banks in the past and so forth and so on. But there's something here about this FAS 157 report. Now, I don't know if you were planning on addressing that at some point. I don't know if I'm jumping the gun. But it's a law that allows them to pretty much, I mean, I'm going to speak in regular terms. They can pretty much say whatever they want the stuff is worth. So if they're actually technically running negative, say $1 trillion, they can inflate the financial products we have to make it in the positive. Is that right?
Yeah, what they're doing is allowing banks to lie about their balance sheets. That's what that comes down to. It's called the Financial Accounting Standard of 157, and it also comes out of the rule, Financial Accounting Standard 78. For the first time ever, dead broke banks did not have to record the actual losses. They were talking on their derivative trades. They were allowed to mark to what they call mark to model rather than mark to market. And the difference between mark to model and mark to market is when you mark the price of your underlying assets or whatever you own, your derivative trades, to whatever you would actually get in the marketplace when you sold them. That would be the real honest price. What this new rule allows banks to do is simply come up with their own assumptions and lie on their balance sheets. They could be totally insolvent and not have to mention any major losses. This is the reason why we have not seen another financial crisis, because everything has been underlying infused with extra money with the Dodd-Frank Banking Reform Act of 2010.
Now, let me jump in here again for a minute. Would an example for people to understand be how the housing bubble is like? How could people lose so much money in the housing bubbles because that land was greatly inflated in value, and so you borrowed money to buy this land, and so now they created money because you borrowed it on a promise to pay. They created that money, but the backing behind it was ridiculously overvalued. And isn't that's kind of what we're saying, except in this case, at least you have land there. There's a real thing there. These other things are more like fictional constructs that are given a value, and then what's coming to us down the pipe at some point is these values are going to have to be exposed for what they really are worth, and a bubble would not be a big enough word to describe what they have created.
Correct. Yeah, they created so many bubbles that caused the 2007 and 2008 crash. But they had not implemented all these infusions of cash, like from taxpayers and from the Fed and from the hard-earned savings accounts. They have pretty much blown all that money now. And this is the reason why you have not seen a stock market crash, even though it should have. But they use all that savings, the savings accounts, and they bet it with leverage into the stock market indexes, which are derivative bets, and they pump it up through all that extra money. It's when they run out of money, everything comes down again, and this is what we are going to be facing here, which is hard to predict when, because there is no transparency when they are out of money of what they've been using since 2010. All the analysts that I've read keep on pretending as if the bailouts are yet to begin, but yet the Dodd-Frank Banking Reform Act tells me that was the bail-in. Whenever you transfer ownership and ensure that the banks are the senior priority recipient of any financial crisis, you have essentially turned over every bank account in this country over to the banks, and now they are the total ownership. The account depositor is nothing more than an unsecured IOU owner. They will never get paid back because they're going to use that money to shore up the losses of the banks. And that's where I believe we're at. I think the modern analysts are missing it. The bail-ins have already came and went. we're now down to just negative interest rates, and I have a feeling they are going to go double-digit negative interest rates, and in order to sell that, they're going to have to, at some point, allow the crash to hit for a few weeks and allow people to see what life will really be like without their credit cards being not functioning or not getting their SSI check or any other kind of subsidy. It will either be live without money, which, our society can't, or you're going to have to accept this negative interest rate scheme, which will infuse the people or the banks. It will infuse them with another batch of money to prolong and kick the can down the road and play the game yet just a little further. But the economy will be hit so hard that it will never recover from this again.
So this whole negative interest rates, this is a scheme they've come up with rather than come out and say, we want to take, say, 10% of your savings or 20% in like one swoop like they've done in other countries. They want to come out and say, well, we're going to take this small percentage, a little, maybe it'll grow, and it's for perpetuity. I mean, it just keeps going on. I mean, it's not going to be like we take a one knock and, okay, you take that knock and then we're done. This is like we're going to keep on. We're going to keep draining. Is this am I characterizing this correctly?
Yeah, in order to save their too big to fail banks, the last bullet they've got to shoot out their gun is negative interest rates. They have gambled far more money than what people have saved, as you well noticed in those figures you mentioned before. If they are betting on margin with leverage, almost 100 times what is been created into existence, then you know that the so-called shadow banking derivative casino has went way beyond fixing. There's not enough money to cover their losses. So what they play this little game where if just the interest payments on the losses can be paid, they can continue the game. They know that principal that has been lost will never get paid. So they're playing these little games by first 2007, 2008, they started with taxpayer bailouts. In 2009, the Fed had to buy trillions of dollars worth of their bad real estate and derivative bets around the world. Then the infusion of people's bank accounts from the 2010 Dodd-Frank Banking Reform Act. Now the only thing that's left is negative interest rates. That's why I believe this program we're doing right now is so important that people listen and see what is going on behind the scenes, and then listening of the little bit of history is what's taken place, because there's not much transparency and the media is not going to educate and inform people on how to get ready for this. They're going to tell you that everything is fine.
Well, let me jump in here for a minute again. What's coming to my mind is like this is something like people who buy houses and then they pay back only on the interest, so they can buy a more expensive house because their house payment is only the interest payment, and so then you never actually ever own your house, and so that principal of your house is gone. You buy this house and you're basically saying, you could take the value of that principal. It's now can be used in your shenanigans, in your number game, and I'll pay the interest. And so in this case, the principal, instead of a house, is going to be your savings. And so that what you're going to be doing is, instead of traditionally getting a return for allowing the banks to use your money, they've already confiscated your money, and they will allow you to have some access to it. It's going to cost you.
Yeah, it's pretty diabolical what they've done.
Also, I want to ask too. I want to ask too before, because I want to say, people, you have come up with a solution for people how they can kind of avoid this trap with their money. And I want to get to that. It's very important. But one of the things that I always wonder, and I don't think I've ever asked you this when we were talking, is, all this money is being lost. Okay, where all these trillions are lost in gambling. Well, if you're in a casino and you gamble, you may lose, you may have borrowed $20,000 that you don't have, and now you've lost that. So now you are negative 20. But the casino is now plus 20 in their accounting books. Whether or not you actually pay it or not, it's another thing. Who's this money being lost to? Who's the people on the other side making these trillions of dollars?
Yeah, well, when you're dealing with the trillion, the quadrillion figure, that is all leveraged betting. That, a lot of it just disappears. What is really being stolen is the principal initial amount. As the average person that invests in the stock market is betting on margin. Most of your electronic trading funds are betting on margin and with leverage. But as we go into a global deflationary meltdown, all the underlying leverage disappears. However, the principal money is always lost, and it is transferred to the so-called new owner. In this case, it's the banks. They are not only being infused from one side, but they get to gamble with as much money that people have saved up, and if they win, they can keep the winnings. If they lose, they just simply dip into the pool of for the new banking law that allows them to own that savings account. So all that underlying trillions and trillions of dollars just really disappears. It isn't really transferred because it was all leveraged in the first place. It never really existed. It was like if you went to Las Vegas with $1,000, but you bet $1 million, the most that Las Vegas can take from you is that $1,000, but the debt is still transferred to you. You see, they didn't win the million. They won $1 million, but they'll never get it. That's my point. The banks bet $1 quadrillion dollars, but the recipient on the other end that won it maybe only won $1 trillion. Do you see?
Right. So as I see this, when I'm trying to put this into some kind of terms, is when say you take the 1,000, you end up losing $1 million. The other side knows you're not going to get $1 million, but maybe they'll get 10,000. Maybe they can bleed you a certain point. You go bankrupt, but you can get some of their assets they get. So their actual real winnings is because they clubbed you over the head with the $1 million of debt, and they only pull out a couple, let's say 10,000. But now they take that 10,000 now, and they turn around and invest it, quote, bet on a leverage. So they got 10,000. Oh, now I can invest 10 million because I got 10,000 from Joe over here. And so they invest the 10 million and they themselves lose. So they now are in that position of owing the investor. Now they'll only get maybe 1 million out of it because they'll be paying it with this negative interest rates or whatever. So this is why I'm saying that the money is not real. The debt isn't real. You could say we're not going to pay it. And it's like nothing will happen because it's not a real debt.
Right.
It's not like I built you a house and now I'm not going to pay you. You're out the money building the house, the labor. There's a real commitment there.
Yeah, the only money that really counts is cash, the printed form. When you pull money out of the bank, which is what they really hate, you're pulling out all the leverage on top of that. You pull out, let's say, $1,000 out of the bank. Well, you're actually taking out a lot of the leverage money that they were hoping to bet on. So when you're holding cash in your mattress or wherever, that's money that they can't do anything with. And I figured there was only, based on one guy's estimation, only $250 billion of printed cash in this country. that can be, withdrawn. Well, if there's $10 trillion of so-called savings, that just tells you that not everybody can pull their money out in the form of cash. So I came up with a way that a person can actually, I've always thought that pulling out your money in cash was the best way to own your own money. But realistically, it doesn't help the person that has, let's say, more money left over. The banks now will start threatening you, and if you try and pull out your money too fast, and in some cases put a halt to it. And so there's a lot of threats that go along with pulling your money out too fast. They put limits on it, and because it unleashes a lot of problems on their end when you do that. So knowing now that they're going to be forced to go into negative interest rates, I found an investment that after a person pulls out as much as they can in cash and saves it so that they can't get their hands on it and gamble it and lose it, I found that there are U.S. Treasuries that a person can buy in their own name that the banks can't touch, and they are not affected by the derivative bets. The banks are sort of notorious, known for losing people's money. So for those that have some money left over, I recommend U.S. Treasuries in the form of long-term, such as zeros. And for those that wish to bet on margin and try and make additional money, I recommend an ETF that will operate the same way. They're still guaranteed by the U.S. government because they are the U.S. Treasuries, but they are still leveraged. And they will, I think, in the future save people's digital money that they didn't pull out of the banks. And I think that is one of the reasons why I called you up and wanted to do this program, because nothing has come to my mind that would help people, help a poor person, and help those that do have money still retain their money and not get hit with these negative interest rates that are going to be a scourge on the planet before too long. Because the next financial collapse will force negative interest rates, possibly in as much as negative 20, maybe even negative 30%. And people will be glad to accept those figures, knowing that the alternative is to lose 100% of their money, and they have no way of conducting business at all.
All right, so breaking this down, your short-term investment is by actually holding the dollar bill yourself. Get as much cash as you can that you can hide and hold yourself, because when things start to deflate and go haywire, you'll have this cash that when your credit card or bank card doesn't work, you can go in there with cash, which will work. So that's number one you were saying. And number two, for those who want to put money in some type of investment, because I don't know how much cash people can actually get before they get on the radar, is this zero coupon bond. Is that what we're talking about?
Correct. And the reason why I like those is because the banks, and it's important to buy those directly from the Treasury, U.S. Treasury, because those are not affected directly by the derivative casino. So when you buy those, you buy them under your name, and you're guaranteed that at the maturity they'll be worth the amount. And breaking down the zero coupon bond, I hope I sent this over to you.
Yeah, no, I got it right here. In fact, let me just read this here. It's really well put. Zero coupon bonds are sold at a substantial discount from the face amount. For example, a bond with a face amount of $20,000 matures in 20 years with a 5.5% yield may be purchased for $6,757. At the end of the 20 years, the investor will receive the $20,000. The difference between the $20,000 and the $6,757 represents the compounds automatically until the bond matures. And when you sent this over, I went, oh, I see what you're saying. Because instead of putting your money in the bank, which is actually, when you put it in the bank, it becomes their money and they play games with it and they could lose it and whatever. You're taking the money and you're having it in this treasury bill, which is not bringing you interest in the classic sense, and then therefore you could be taking out interest, is you're saying, hey, I'm buying a 20-year bill. It's going to be worth $20,000, but I'm going to pay $6,700 for it, and in 20 years I'll get 20. And it's a clean thing, and the only thing that could fail would be if the whole government and the whole, we're back in the Stone Age, then I guess it won't matter. But at that point, we got a lot more trouble than that.
Now, the third method, and this one is the one I'm really excited about because this is a way a poor person can become very, very rich because they don't, if you understand how negative interest rates are going to be a scourge, Bill Gross of the PIMCO hedge fund company, he is probably a master on this negative interest rate scourge that is going to hit. He's come up with a electronic trading fund that I think will make poor people very rich and will save anybody that buys this. And what he's established is an electronic trading fund that works off the zero coupon bonds, but it also has a speculative aspect to it where if hypothetically, if we go into negative interest rates, as I have been talking about, which I believe is a guaranteed locked-in event because it has the banks and the Feds have no control over this deflationary debt spiral that we're in. This thing will magnify the share price enormously. At the present, I might as well give out the symbols on this trading, and there's only two that I recommend that will work on this principle if anyone's interested. I, for one, will put $20,000 down on this without blinking. I have that kind of confidence on this. And it trades under a 20-year zero-coupon bonds. The trading symbol is TLT, which is Tom, Larry, Tom, and another one, which is a 25-year zero-coupon bond. And it will trade under Zebra Robert Orlando Zebra, which is ZROZ. I've been watching these for about a month now and been studying zero coupon bonds. And of course, this is the speculative side, and I'm not an expert, but I do know that whenever I see these things going up, when interest rates are just barely creeping down, I've noticed that, and with the stock market going still up, these things are not losing money. It's like they should be, but they're not. But when they go into negative interest rates, these things will catapult I think, into the stratosphere. Unfortunately, the bad thing is that they are already running at close to $130 to $140 a share, but that can still be bought by the average guy. But this is the speculative part of me, and I kind of like this idea, and I think it will protect a person against future confiscations, and I think they'll get ahead rather than fall behind, because in the next financial global meltdown, I believe a lot of jobs will disappear. As much as we have 95 million people that are not working in this country, I believe an additional 50 million will lose their jobs in the next financial crisis. The only thing that can pull them out of the fire is something that will make so much money that it will make up for all the losses that the banks have stolen from them in the past. And this is what I wanted to pass on to you and your listeners. They don't have to do this. I'm not an expert on these areas, but I have no problems investing in this myself, and I just wanted to pass it on because I know that we're all going to get caught in this negative interest rate scourge that's coming around the corner. So
let me mention here, I was doing some poking around. I have it up on the screen now. Looking at these bonds you're talking about, the 20-year plus year Treasury bond ETF, the New York Stock Exchange TLT, that's what you said, right?
correct.
Gained, so far this year, it gained 10.8%. And the PIMCO 25-year zero coupon U.S. Treasury bond, which is the ZROZ, increased 16% this year.
Yes, and that is just while we're still in the positive column with interest rates. When we go negative, these should just really go ballistic. They'll go into not only the thousands but 10,000s per share because of again, they are going to be leveraged and maxed out. And the only way you could lose money is if they ever raise interest rates. But you notice that last time the Fed raised interest rates just a quarter of a point, almost 6 months ago, the stock market collapsed 3,000 points. If they try and even raise interest rates another quarter of a point, we could see as much as a 6,000 point drop in the stock market. So they don't want to be blamed for the next stock market crash. So the only way they can slow this crash down is to continue lowering them, and eventually things will get so bad that there will be a collapse, and then they'll be forced to really hammer people in the banking sector at probably double-digit negative rates that could be anywhere from 10 to 30%. That's where these electronic trading funds that I just mentioned, the TLT and the ZROZ, will skyrocket and make an enormous amount of money. So that's why I have no problems. I won't even bat an eye with $20,000 on this at all.
Now, I'm looking at these. The TLT has a 17-year duration. I mean, so when people buy this, that 180 or whatever you said dollars is that's taking a 20-year trip, and the other one's 25.
Well, that's the nice thing about this. This is, you don't have to wait the duration or the maturity date on the zero coupon bonds. You can trade these in and out based on whether or not the interest rates go up and down. So this is strictly for a 2-year investment plan for me. That's the way I look at it, because I feel 2 years from now we're going to be looking at least 15 to 30% negative interest rates if a crash should occur between now and then. And
so in other words, there's probably a penalty for selling early, but you'll have made so much money that it doesn't matter.
No, there's no penalty.
You can sell. I mean, I'm trying to understand, because if you buy a 20-year bond, you could sell after 2 years, and you get the interest that the 2 years have acquired.
Yeah, the normal zero coupon bond that you buy from the U.S. Treasury, there might be a penalty to extract it early because it's set up to be mature according to whatever the 10, 15, 20, or 25-year maturity date.
Okay, well, let me ask you then. So these guys, they're buying the Treasury bond, and then they're selling you shares in the Treasury bond. Is that how this works?
Are you referring to the actual Treasury bond from the Fed?
Yeah, this TLT and the ZROZ. Okay. Those guys are buying the Treasury bond from the Fed, and then they're selling you shares in what they bought, and the difference between
it's more linked to a bet on the direction of interest rates. That is where the magnitude of the bet is really being placed on. Again, you're dealing with a financial instrument that they created so that they can make a lot of money in a short period of time without having to wait for the maturity date like a normal purchase of a zero coupon bond.
Okay, so in terms of, I saw The Big Short recently, which that movie I highly recommend because it really explains the whole shorting of the real estate market, which made some people, a very small amount of people who saw it, a very lot of money. So what this is basically doing, if not necessarily literally, but in a figurative sense, is you're selling short on the interest rates going negative versus going up. So if the interest rates rise to 10%, let's say, this is going to be a problem for this fund. But if it goes to minus 10%, it's going to be very good.
Correct.
Okay,
Correct.
I see. All right.
Yeah.
I understand. I'm just trying to, if I can put it in those other types of terms, I know it helps me and it might help other people to kind of understand it in his examples. So, okay.
Yeah, that's how I understand it. And you're initially betting on negative interest rates to come out in the future. And
some people might be going, this is crazy. Of course it's not going to go negative. What are you talking about? And those same type of people said, what, selling short on real estate? Come on, it never happened. No one's ever done it before. You're crazy. You know, and then those guys made billions. Well, everybody lost hundreds of billions. And now in this case.
Yeah, for instance, the real estate, there's certain trading symbols that deal with on real estate. They're called REITs, and one is known as SRS. That's the trading symbol for that. And let's say that in 2007, 2008, it went up as high as $17,000 a share. Well, right now you can buy it for about $35. The next financial collapse will cause it to go right back up to $17,000 a share. The reason why I don't like to go into something like that is I don't know if it can get cut in half again. However, I know that interest rates are going to go down and continue going down, and if the Fed so much as even raises interest rates at a quarter of a point like they did last time, you're going to see a 6,000 point drop in the Dow. Because it takes money away from the banks, and the banks right now cannot afford to pay out interest on any account because they've already are dead broke.
Now,
this is why interest rates.
How does somebody go about, like, say I wanted to buy these things, or people listening, how do you go about investing in these bonds?
Okay. Yeah, you can just buy like through Scottrade or Ameritrade, open an account and buy it accordingly like that. You can do the trading yourself. It costs maybe $10 to make the trade for as many shares that you want.
Is there any kind of maintenance fee to continue? I know when I bought some after 9/11, I bought some airline stock because I knew the airline stock crashed. I'm going, like, really? Like, the airlines are going to go out of business and no one's going to fly anymore? Really? So I bought stock, which, you know, it doubled and what have you. But I had to get, by holding the stock, once it already achieved a stability, I had to pay a maintenance fee, which cost me, I figured I'd just sell it, you know, because I'm not, it's not going to go up and down. It's not going to go up anymore. I'll sell it because I'm going to end up losing what I gained by paying maintenance fees.
Yeah, if I don't believe that there's much of a maintenance fee on this particular one because there's nothing to maintain. All they're doing is managing the fund with the bet. So they might have some kind of fee, an annual fee, but to me it's nothing. To me, it's not. Bill Gross came up with this, and I know why he came up with this. And when I had a conference call with the district manager with J.P. Morgan a guy that worked for that, I discussed this matter with him, and he now has quit his job and pulled his money out of the stock market and put a lot of it in cash and doing this as well. So I've had several conference calls with him ever since. I know a good deal right now, and this is probably the best thing I've been able to come up with since I bought gold and silver back in the year 2000. And that's, even though I know that gold and silver right now will have a temporary push upwards, it will collapse again when the financial crisis hits us again. And I'm not going to predict this time when that happens because there's not enough information for me to say when. But I can sense it's close.
Well, I'm looking at these charts. I mean, I happen to look up. I'm sorry, I'm kidding you off, but it's only because of for sake of time, and I want to get this information out. So I don't mean to be rude, but I'm looking up this TLT on iShares. I'm looking on their website. Currently, it's 139.74, and it's up 1.06 points for a 0.76%. Year to date, 17%. That's huge. And I'm looking at the chart, a historic chart. It goes back. It has been increasing with some minor ups and downs, but it's been increasing since August of 2015.
Yeah, when I look at this, it's the safest poor man bet that I can recommend to the average person before it goes into the thousands of dollars a share. Once we go into negative interest rates and a financial collapse hits, this will go into the tens of thousands overnight. That's how it'll turn a poor person into a very rich person very quick. That's why I have no problems putting money in it, because the downside risk is practically non-existent at this point, because raising interest rates is the last thing that the Fed wants to do. They tried it, and it was a disaster on the stock market, and they know if they try it again, it will be worse yet.
Let me look at it. To mention this another way, is that if you would have put $10,000 in, within a 2-year period, you made almost 13,000. So you're talking about between $2,000 and $3,000 currently, you would have made in 2 years on a $10,000. And where are you going to get that kind of increase? I mean, you can't put it in a savings account. What is it, 0.25%? And now
right,
now it's going to go down to negative. So, I'm not a big financial guy, but I mean, even I can understand this.
Yeah, it's the only way to treat the money that you haven't pulled out of the bank on a physical level. That's the way I look at it. Otherwise, the best thing you can do is pull your money out of the bank before everybody else does. And with only $250 billion out there, I bet the banks don't have much time before we go into negative interest rates. Everybody will want to pull their money out.
All right, well, let's talk for a minute here about credit card interest. Now, while this is going on, if they're going to start charging, interest to savings account, what does that say for the interest on credit cards? Is it going to go like astronomical?
Well, I don't really know, and I don't really care because I've always had enough money where I've never had to get a loan. So I never had to make payments on a loan. Even when I bought a home, I bought it outright. So
you're one of the 0.0% of people who have done that.
Yeah, so I've never had to go to the bank and ask for a loan. So I can't relate with a person with loans. I hate banks, and I know, to give you an idea, this whole idea of them owning your bank account actually goes back to 1844. They've always had the right to own your bank account. It's just that down through the decades, they've given restrictions and on the bank and protection measures for the depositor, such as Federal Deposit Insurance Corporation, which is dead broke pretty much. And they used to have what was known as the Glass-Steagall Act of 1934, which protected the depositor from the bank having to ever bet with the depositor's money into financial instruments. But in 1999, that was repealed by the Clinton administration, giving the banks the right to do with your bank account whatever they wanted. And then when Dodd-Frank Reforming Act came, it gave the bank senior priority to be bailed out first, and the depositor absolutely no safety net whatsoever.
Mm-hmm.
That's a little bit of a history on the banks. So they've always, since 1844 out of England, they've always owned your bank account, but people have always thought that when you make a deposit in a bank, the legal transference goes to the bank. They own it. You don't. You're just an unsecured IOU person as far as they're concerned. So that's the way it really works today. The only way you can own it is to pull it out of the bank, have it in cash, or buy U.S. Treasuries in the form of directly from the Fed under your name. That way, it belongs to you. Any other method, the bank owns it, and they can gamble with it. And if they lose it, they're not losing your money anymore. They're losing their money, and you're just out of luck.
But these
That's the way
these iShares are different. They're not like the bank buying it. This is a fund, and can the fund stiff you?
As far as the two symbols that I gave you?
Yeah, right.
Well, since they're still dealing with zero coupon bonds, no, they're still protected.
Okay.
So
this is amazing because I'm looking at some of these figures and the 52-week projected. Now, this is based on current markets, current trends, which I understand is, past performance is not indicative of future gain. I understand all of that. But given what you're saying is that this is going to go up continually, possibly a rocket like you're talking about. But even at the current rates, let's call them modest within this range, they're looking at about 120 to 130 point gain by the end of the year on this, which, it's going to like double the value if I'm understanding this right. If I'm reading it right, the price is going to like double. It's something that people should do rather quickly, I would imagine.
Yeah, this allows the person to put their hard-earned money in a financial vehicle that the banks can't get their grubby hands on and gamble it away again like they have done since the last few decades. So this is the best idea that I can come up with to help save a poor person that is going to go under for the third time. And it provides a very good saving mechanism for the rich person that doesn't know what to do with their money right now because they think they need to go into gold or silver or back in the stock market when it's trading at an all-time high. So I don't trust the bank ledgers of the financial system now because I know that lowering interest rates is telling me things are getting much worse, and we're very much at that pinnacle point where we could see another financial collapse very, very quickly. It could start over in Europe.
I got it on the screen now. I was looking at my laptop and I got it on the screen now to show this example. I mean, you're not necessarily recommending iShares.com, but this is just an example of this fund and what it's done. And it's like, I guess, why is this something that's not, is it because it goes against the grain, just like when you were talking about selling gold because it was going to collapse? The idea here is that you're thinking of hyperinflation and higher interest rates, whereas this is actually geared toward interest rates going down and thus promoting deflation.
Correct.
So I mean, it's
correct.
against the normal grain, And think about it in terms of shorting the housing market, which never was done. I mean, I'm watching this movie, which was a movie, but then they actually put in the real stats along the way. They would look at the camera and go, well, what really happened was, and they would tell it. It was kind of interesting how they filmed it. I mean, they had when this guy wanted to short the real estate market, it was getting kind of laughed at. And the guy's like, "You're serious?" Well, heck, we'll come up with something. And these people actually created a short fund for this guy, which never existed before. They were kind of laughing at him, and for a while he was actually losing money into it. But he, being a math genius, he said, like, no problem, it's going to collapse. So it ended up paying 4,400% on the investment by the time he closed the fund out. Once this whole thing happened, and so this is another one of those counterintuitive, but very logical when you think about it. And you're basing on, and I was looking up the negative interest rates prior to going on the air, and there's a lot of people out there going, no, we don't think that this is necessary at this time and all that. But the way they're saying it, they're not saying it'll never will happen. They're kind of like trying to talk you away from looking at that. And some of the quotes that are from this particular document that people can download, again, I want to mention that. If you're looking at the YouTube video, scroll down, there'll be a link to it. And if you're listening to the audio, you can get it now live, and I'll have it with the audio. It will show that they're saying, the Fed chairman saying the negative interest rates are not off the table. They're not saying, no, it's never going to happen. Of course, even if they did, doesn't mean I believe them. But the fact they're not saying no tells me it's a yes in the wait.
Yeah. They have no other direction but to lower them from here on out. It's just a matter of how much. That's
all right. Then did we cover? You have anything else you want to say in it? Did I kind of? I don't mean to cut you off here and there. I don't know if there's something else you wanted to say.
Since this particular idea didn't come from me, it really came from Bill Gross he was a PIMCO founder. I'll quote him, and he states, investors have few options in a world of low or negative interest rates. He went on to say, the sun, which sustains and nourishes life, will one day devour the earth. The sun, in this case, is the global credit-based economic system, which, accordingly to Gross, appears to be in the process of devolving from a production-oriented model to one which recycles finance for the benefit of financiers. He cites astounding growth in credit from $1 trillion in the U.S. in 1970 to $58 trillion today. Gross thinking negative interest rates in Japan and Europe are what happens when this debt star enters its death throes. Investors are left with almost nowhere to turn, as bank deposits, equities, treasuries, and bonds have returns that are inadequate relative the negative rates to historical as well as mathematically defined durational risk. What he's saying is that negative interest rates is going to devour everyone, and it will. It will put the final nail in the coffin of this economy here and destroy it. I mean, he also goes on to say other things, but my point is he created this fund to save people's lives, and I can see why. He thought it through, and I kind of figured it out after reading about negative interest rates, and I wanted to pass it on. And I knew if I talked to you, this might give the opportunity to somebody that is listening some hope, rather than all the doom and gloom that we're witnessing and unfolding on a day-to-day basis.
And what they're going to be paying this? I'm looking down past a big collapse, right? I don't know if some point things get so bad it doesn't matter anymore, but what would they pay it in down the road with a huge across-the-board financial collapse? I mean, how does it get paid? How do you get paid?
Yeah, that's ultimately what we will see in the end is a total and complete collapse. Negative interest rates will simply slow the process down, and that's all.
And so you can get some money via these funds during that time, so that's one way to increase money,
right?
As this collapses. But of course, when it does hit the ground, that's why you got to have cash in your house, and that'll tide you over until they come up with. Then
in the Great Depression, if you had just $1,000, it spent like almost like $1 million. So, always have at least 70% of everything you have out of the banks and in cash. This is still the world reserve currency, and it will still remain that way. Otherwise, they wouldn't be going to all this extent to save the banks. Ultimately, they have parked their money in dollars in offshore accounts, and they have every intentions on saving those accounts. And the only way to do that is to do what they're doing, which is to go into negative interest rates. Otherwise, they would just print the money, pay off the bills, everybody's bills, and we'd have massive inflation, of course, and nobody's account nobody would have enough money to pay for anything. So deflation is the name of the game, and it's going to stay the name of the game from here on out. And that's why you're going to see lower interest rates and negative interest rates. That's the way I see it. And I just wanted to say that this information being passed on, I believe, will save people's lives. Very few programs are going to save people's lives. Usually they're just providing the doom and gloom and not providing a real answer. And I have no vested interest in selling this, because I have no meat in the.
Well, I do notice that if you listen to alternative type radio shows who are exposing things going on in the government and whatnot, universally they're touting buying gold and silver. I mean, so I can see saving food. You can store up food. I mean, that's a value you're going to have to eat. I mean, so if you buy a year's worth of food or 2 years of food, it's, fine. You're going to have to eat. But if you save the dollars, cash in your hand, you're going to be able to buy 10 times that amount of food or more with the dollars. Even though you've already paid expensive dollars for food, now you can buy stuff with the cash. Of course, I mean, you could get robbed, and I mean, it's not like you're going to walk down the street with $10,000 in your pocket and people are going to go, "Oh, well, congratulations." But so I mean, that's why really you had me thinking on this back in the day with the gold. Is that no matter what you buy now, you're buying it with an expensive dollar versus saving that dollar and then walking out into a deflationary system with that dollar. You're going to be able to buy an awful lot for that dollar during those times. Not that you're kind of hoping. You're not. I can't wait for everything to collapse so I can make money. That's not the point. But it's self-preservation we're talking about here. What's the best way?
We're talking about people's lives are at stake at this point, and there's precious few financial instruments that will save you outside just taking money out of the bank. This is the only one that I would recommend, and that's why I'm passing it on. I think it's the best idea I've come up with in 15 years, and based on my analysis, and I feel confident about it.
Well, I mean, just looking at it now, it looks good, let alone with a negative interest rates hitting the ground coming in. So I appreciate you taking this time. You didn't have to do this, and so I really appreciate you spending the time to give this option out, and that the people, I'll do what I can to disseminate this, but hopefully other shows with a bigger reach, if you will pick up on it and go on like that. So, but at least people listening now and from the website and then from YouTube, you'll have that option. So I thank you for, instead of just taking this and keeping it to yourself, so to speak, you're thinking of those people out there, and I appreciate it.
Yeah, I appreciate having me on your program and talking about it.
Well, like I say, this is why I'm here. I mean, this is the kind of stuff that I do. I'm tired of talking about Planet X and all this other stuff. when something comes up that's really important and we need to hear, I resonate when you were telling me about this. It's like, we have to get this out. In fact, we pushed it up to today. I got rid of the other guest. I told him about it, and he said, no problem, So we pushed it up today so I can get it out in time. So hopefully I'll have the video up tomorrow even, because I am off. So hopefully I'll do that. Again, thanks a lot, Lionel, and we'll be talking.
Okay. Bye now.